Okay, so just to recap a little bit, I had the mystery of the labor market, the mystery of the stock market, and whether interest rates are too high or too low is kind of the three questions. And the my labor market story is that we are now uh, doing doing less with more. That is, uh, making less productive use of our resources than we were before, partly regulation, partly industrial policy, partly just the world backing away a bit from the globalization of the previous decades. And for the stock market, there is a return to TINA. There is no alternative, especially with the international situation more uncertain. People are willing to buy US stocks, and then they seem to have uh, kind of found a shelling point in the top tech stocks in the US as being somehow the solution to where to put your money in this uncertain environment. And then as interest rates, I think that's I may not have as simple a story there. Uh, I think there's a tension between the need, the need in the for the government to have a negative real interest rate to try to bring down the real cost of the debt, and then the need for a positive real interest rate to slow down inflation. And so I think we're kind of caught between those things. So that's my quick and dirty summary of where I think we are. Um, so first question then is, where is the recession that we were all looking for? Is it out there already in the product market, but hasn't quite hit the labor market for some reason, that there's just too much momentum going on? Or is it delayed sometime in the future? Anyone care to venture an opinion on that one? I mean, we have people with opinions here, so I expect something. All right, Steve, go ahead. You have to unmute if you want to.
I would say it's not yet here. It is coming. And when I would say it's probably very likely within the next 12 months. But as I stress when I talk to clients, even though that's my strong conviction, that doesn't really tell us much of anything about the future, because I have no view on the depth of the recession, if it's going to be prolonged, short-lived, very deep and painful, very quick, shallow. I think really any of that is in the cards, but it doesn't entirely surprise me that it's not here yet. But I do think it's very likely coming. I think the yield curve gave us some false indication of how likely soon it might be. Whereas if you look at leading economic indicators today, it really just been recently that we've seen it turn in a way that you would say is a substantial likelihood of recession to come. So still potentially a quarter to 2 quarters away from seeing the beginning of it.
Yeah, turning points are almost always easily seen in hindsight and rarely spotted ahead of time, unless you know, sort of a perma bear or a perma bull or whatever. And so,
And you're wrong a lot.
yeah, then you're wrong a lot. And speaking of wrong a lot, I think I've been a perma bear on the stock market. So I was pleased to read, like, there's been some stuff, I forget where I came across. I probably put it on the Substack, that the stock market can be a lagging indicator when there's a recession, that the stock market will hit bottom after the economy, not before, or after, or certainly after a recession has started, and not before.
Yeah, I didn't think I saw that today. I didn't really agree with that. I I think every time is a little bit different, but if you look at different aspects of the market, some of the market is priced in a recession pretty clearly already right now. If you look at small cap value, it's as cheap as it's been in the last 2 decades. The only other times it's been this cheap was COVID and the Great Recession. Very
Yeah,
different in the S&P 500 where it's
or the
priced.
S&P 8.
Yeah, exactly. Yeah.
Yeah,
Consumer
no,
indicator technology.
so one coherent story for the stock market would be, I think there has been a tendency for the big companies to gain at the expense of smaller businesses in general. I mean, I think it's been, my guess is it's been on average a bad couple of decades for the for small business people. The average small shop owner has faced Walmart or Amazon. The small business that was located in downtown urban areas has faced COVID and remote work. And, there's just, so it could, in some ways, the stock market may be trying to tell us that there's been what they would call a rotation, but really a profit rotation out of small companies and into the giant winners. But again, I wonder if they maybe gotten ahead of themselves on that. Maybe they're projecting more winning from NVIDIA and Meta and Google than is really in the cards. But anyway, anyone else have a view on an impending recession? And if Lee is silent, I'm shocked. So
I'll take that as an invitation. So I know that I was very vocal about calling for a recession in this very forum. Maybe, I don't know, when was that, a year ago or something,
right.
that we had that discussion. I even posted in the notes of one of your pieces that I thought it was a good time to buy puts on the S&P, which, by the way, did fine for a little while,
Yeah.
but then the market bottomed, and then those obviously expired worthless, as most options tend to do. I don't perceive a recession on the horizon. Things don't feel recessionary right now. I wrote a piece on my Substack a few weeks ago, which was drawing from the most limited number of data points. And my conclusion was that inflation has peaked and that things are under control. My data points for that, by the way, for those who didn't read it, were that eggs, a dozen eggs is now $1 in New York City, which is quite a bit lower than it was 6 months ago or 9 months ago, when there was like this egg mania and eggs were like $5 a dozen. And also, I went to the supermarket and Haagen-Dazs ice cream was only $3.50 a pint, and it was $7.29 not that long ago. So based on those two limited data points, I made the sweeping conclusion that inflation has peaked. I know that's not great reasoning, but things don't feel recessionary in any place. I read a lot about how bad things are in the commercial real estate sector. Maybe that's true across the US, but in New York, commercial real estate seems like it's doing a-okay still. So I don't know. I'm taking some very limited data points and extrapolating from them, which is really dangerous. But it doesn't feel recessionary.
So we have the cost of living index consisting of eggs and Haagen-Dazs ice cream.
Right.
That's good.
Which is basically most of my calories. So,
yeah. Okay. Well,
I would just say one more thing, which is I have believed for years I've also said it in this very forum. I have believed for years that we are wildly undercounting productivity statistics. I don't know how to fix them, but I think that the economic historians will look back and have figured out there will be someone will earn tenure at Harvard by figuring this out. Like, we are truly dramatically undercounting the productivity numbers, and we're doing that on an economy-wide basis. And so if that is true, it means that the natural rate of inflation and of unemployment are very different than what we seem to think they are. It may mean that real economic growth is higher than we seem to think it is. So that is, to me, the most dominant non-consensus economic opinion that I hold.
Yeah. Well, I think it's very hard. I've written a lot that I don't think productivity can be measured as, precisely at an aggregate level as people claim. One of the things is the Garrett Jones tweet that most people don't make
By the way,
widgets; they make.
I ordered a replacement part for the scrubber.
I'm gonna mute somebody. That people don't make widgets, they're building organizational capital. That's your typical employee. And so that makes it very hard to measure actual, what's going on with productivity. For example, all these tech layoffs. It's not like at the margin there is going to be less, let's say Google lays off a bunch of people. It's not like at the margin there's going to be, I don't know, less revenue at Google as a result of laying these people off, at least in the short run. What they're laying off are people who are, who in some sense are overhead. I mean, almost all labor is overhead in this kind of Garrett Jones world. There's nobody, manning the marginal server at Google or whatever. I don't even know how you would describe the marginal output at any of these tech companies. And so it's so even this concept of productivity is very hard to relate to those. It's one thing to have a automobile company and you can measure how many cars get off the assembly line and you can divide that by the number of workers. I don't know how you do that in things like healthcare, education, and high tech. So anyway, so I agree with you, Lee, that the productivity is, well, I would go so far as to say it's very hard to track. And then so certainly one possible scenario is that productivity is quite a bit higher than official numbers would suggest.
So if you took that, let's just like run that to its conclusion. Let's say the official numbers are that productivity growth is, I don't know, like 1% a year or something like that.
Yeah.
Let's assume that it's something wildly higher than that, 6% a year, 5% a year, something like that. What's the implication of that on an economy-wide basis if productivity is in fact not just like a tiny bit? It's not, we're not saying like 20 basis points higher, but massively higher.
Yeah. Well, you would think that you would see prices performing much better, basically heading down. And then the question is, are we just not noticing that? I mean, by the standards of, let's say, 1950, and what it can provide, an iPhone might be worth $1 million. I mean, I've seen that argument that, if you were trying to, buy, get a stereo, something you do long distance. I mean, I had my my son-in-law here this morning just casually calls his parents in London just to do a video chat. I mean, that's, tried going through the cost of that 30 years ago. I mean, I'm old enough to remember when, somebody'd say, "Hey, it's long distance," meaning you got to cut that phone call short, and and you couldn't do video at all. So anyway, that's so where that would show up is that somehow, as statisticians tried to quality adjust things, they got things wrong. But then you'll have old coots who say, well, healthcare and education have shot way up, and you probably don't see that kind of productivity growth in education. That hasn't shown up. And so
But
anyway,
if productivity is really that high, it, I think, would mean that interest rates can and should stay lower for longer without it being inflationary, right? That for the decade or whatever that the Fed kept rates below 2% or 1.5% or something, and you had lots of people saying, well, this is going to cause inflation, and then it didn't. One possible explanation for that is because productivity growth was so high that that's disinflationary, the effect of that. And so if that productivity growth is continuing to be that high, maybe you can swamp it for some period of time. You can print so much money that it offsets the productivity growth. But if the productivity growth stayed at that very elevated level for a long time, it would mean that the natural rate of interest shouldn't be 7% or 5%. It should in fact be closer to like 2%, and that would not be an inflationary rate. Isn't that right?
Yeah, well, so that brings up the topic of, are interest rates high or are they not high? And that, you typically think in terms of the real interest rate. And here's where I get trouble with, I want to put up a commercial for there not being a GDP factory, therefore there's probably not a single real interest rate, and there's probably not a single productivity rate. One of the consequences of high productivity growth in some sectors of the economy is you get the Baumol effect in the other sectors of the economy. That is, the sectors where productivity growth is low are the ones where you get the biggest price increases. But back to the real interest rate is the interest rate adjusted for inflation. And if you believe, I think if you believe a story that says productivity growth has been underestimated, that is pretty much equivalent to saying that price increases have been overestimated. The rate of inflation has been overestimated. I don't think you can believe one without the other. And so if you believe that productivity growth has been underestimated and therefore inflation has been overestimated, then the real interest rate has been underestimated. If you can follow me there, that is, if you think that we've been observing inflation rates, like up until a couple of years ago, observing inflation rates of 2%, but they were overestimated and they were actually, let's say, negative 2%, then the real interest rate, the interest rate minus the rate of inflation, instead of being close to zero, is probably close to 3 or 4%. So that would be a consistent story there.
So by that same logic, then, which I think my personal opinion is that is the case. So if that's the case, then right now when you have interest rates of, the Fed funds rate is what, like 5% right now or something? Yeah. So 5 minus the inflation rate, then arguably the real rate of interest is maybe a little similar to where it was, or even
Yeah.
a touch lower than the real interest rate was in the past, I guess. Is
Yeah.
that what we're getting to? Yeah.
That could be, yeah. Again, if we're gonna revise the first 2 decades of this century, revise the inflation rate substantially downward, then we're gonna revise the real interest rate upward, and we could still be in a similar real interest rate, even though inflation, even though the nominal interest rate is higher, and inflation is higher. I'm not going to sign on to that. I think we're going to give it as a possibility, but it wouldn't be my story. My guess is that real interest rates, I would go with sort of an old, take the inflation numbers at their word, so to speak, take them as not being wildly overestimated. And then say that, yes, real interest rates have been low, and I think that they may still be low now. I think one of my fears is that it's in the interest of government right now to try to repress interest rates, keep them below the rate of inflation, because that's the only way to get out of the debt hole that it's in. And so that would be, that goes back to something I talked about at the beginning. This, on the one hand, if you want to fight inflation, you need, at some point, you need a positive real interest rate. If you want to get out of the debt hole, you need a negative real interest rate. And you'll recall, maybe, do you remember the Lynn Alden piece that I linked to, that quote where she said that in some ways higher nominal interest rates are a stimulus because it forces the government to spend more on its interest payments. And I just got an email I'm on the mailing list for the Committee for a Responsible Budget, which is this, kind of perpetual doom group on the government debt. And I guess they cited the Congressional Budget Office projection that in another 20 years, interest payments on the debt are going to be higher than anything else. They'll be higher than Medicare. They'll be higher than Social Security. And that we're sort of moving in that direction. And that there, I've been saying some things that are unsustainable for years, and then they've kept going in the same direction. One of them was, the debt was unsustainable. I mean, I wrote something probably 15 years ago, guessing the trigger point for a debt crisis. And I said, well, if you get to, X percent of GDP and sort of an unwillingness to cut budgets more, you're going to hit, you've got to hit it at some point. I said would probably be, probably right around now. And of course, the deficit, as the debt as a percentage of GDP now, is higher than what the CBO was projecting back when I wrote that. So, we've avoided the debt crisis that I would have said was inevitable by this point. And again, the stock market, the price earnings ratios. I mean, I gather the last couple of quarters, I guess people are anticipating what the second quarter will look like. Earnings are down, prices up. How high can the price earnings ratio on the market go? I mean, it does have room to increase. I mean, if the risk premium just falls to, almost nothing, you can have, a very, very high price earnings ratio in the stock market. It could be 40, it could be 50, but historically it's, 10 to 15, and now it's somewhere between 15 and 20. Can it go on forever? I don't know. Is there somebody more out there more bullish than I am on the stock market, so we can get the not get the same consensus that we got 14 months ago to buy puts? Come on, somebody raise their hand.
Well, I would say, and I kind of want to relate this to bailing out your prediction that you think didn't come true. So unsustainable debt doesn't have to transpire into a crisis. It can just mean prolonged lower trajectory growth for a long time. It can just hamper, and that plays out in a compound way that you don't ever see or perceive. But if you lower real GDP growth by 1% per year forever, that's really painful. Same thing with what might happen to the stock market. It could just be flat for slightly down to flat for 6 months to a year, and that's pretty painful relative to what people have been experiencing. It's not a crash.
Yeah. But okay, roll the tape forward to the year 2050 and assume that we haven't had any sort of, like an AI miracle or something that, is, tripled GDP or something,
Or extinction.
Extinction. Well, let's go for the triple GDP. So let's say we haven't had that. We now are trying to pay more in interest than we're paying for Social Security and Medicare. I mean, it's like physically impossible for the government to come up with that money. At some point, so that is by definition a crisis. That's like Greece a few years ago, or Zimbabwe, or I mean, if you can't pay your bills, that is a crisis. And the question is, if at what point, and this was actually my, the essence of my paper, at what point before that becomes painfully obvious? Does it become obvious enough that people don't want to put their money in bonds that they don't think are going to be repaid? Again, it's easy to see with a third world country, and again, going back to something I said earlier, I think people do have that the fears about third world countries have gone up, I think, for sort of Peter Zeihan type reasons, which is that the United States is backing away from its role as guarantor of everybody. Although, I mean, it's obviously not backing away in Ukraine. But if it is in general trying to back out of that role, then third world countries in general are more vulnerable than they would have been 10 years ago. And so people living there would be more likely to buy US assets, including our S&P 8 and our government bonds. So anyway, that's actually my theory of why we haven't had a crisis, is that we're in the tallest pygmy situation where people look at U.S. government bonds and say, compared to what? Compared to Germany, which doesn't know how to deal with energy other than to buy it from Russia, compared to France, where they're burning down the streets, compared to the UK, where the NHS is falling apart, and there's just nobody seems to be able to run the country, compared to Japan, where the median age of the population is just it's going to be above the working age pretty soon. Compared to China, where they have the same aging problem. And so people look around and say, well, That US government looks like a good bet. Um, so no one wants to challenge me on that one. I'm just,
I think someone's trying to talk.
or Ernie, if
but
you
on
want to
mute.
talk, you've got to unmute.
Am I unmuted now? Yeah.
Yeah,
In the short term, that's probably true. But using 2050 as a target, though, people that the baby boom basically will be dead by 2050. People that are turning 65 now, that's the peak of the baby boom, was 1958. And 25 years from now, they'll be 90. So that's going to get in the way of I mean, Medicare and Medicaid payments probably will be dropping, but between 30 and 40, things are going to get kind of tight around here, mainly because of that. And it's showing up in the labor market as well. There's a lot of people that have to replace people that are turning 65, which the peak of the baby boom is doing this year. And the next couple of years, that's probably true. So just like in the 80s, I don't know, you may or may not remember in the 80s that there was a lot of pressure to hire a lot of people were being hired to replace people that were retiring that were born in the 20s. And that cycle is still going on. And by 2050, most of those older people won't be here. That includes us.
yeah, right.
So I think the problem, if it's going to show up at all, is going to show up in the next 10, 12 years. We're going to see some problems with the government's deficit getting bigger
Yeah.
because of that.
So I wonder what it looks like in Japan with that, because I mean, you'd think that the ratio, the dependency ratio in Japan ought to be just super high. And they've already got one of the highest debt to GDP ratios around. Yet there's no sign of a government debt crisis in Japan. I mean, I guess
Japan has a lot of investments around the world too. They've, I think it was Peter's Zihan.
Yeah.
He made the case that Japan has looked ahead and made investments in other places in the world where the population is not quite as old as it is in Japan. They made a lot of investments in the United States and Korea,
yeah,
and other places in Asia.
Yeah, they're certainly as a nation a high saving country, and that showed up in their kept running balance of payments surpluses, which we were always angry about. But that the flip side of that is that you're investing a lot overseas and buying a lot of T-bills. I mean, the joke is, what did we send Japan in exchange for all their electronics? We sent them our pieces of paper with with the Treasury Secretary's signature on them, which seemed like a good deal for us for consuming. But it's that presumably what they're going to do at some point is, pay for their benefits by cashing in some of those investments. Yeah.
Well, in your term, I have a question I've put before everyone. In the next week or so, there'll be the new inflation numbers are going to come out, and arithmetically, it's unavoidable. There's going to be a big drop in the year-to-year inflation number, mainly because 40% of the increase that occurred in the last 12 months occurred in 1 month. That's now off the table in terms of year-to-year comparisons. So the announced year-to-year CPI increase is going to be much smaller, I think, than people expect it to be. And I just wonder how everyone's going to react to that. The newspapers should have been aware of this a long time ago, but I think generally the layperson and probably a lot of the market doesn't realize that inflation's really been pretty low since last the monthly rates anyway have been pretty low since last June.
Yeah, I think that's right. I mean, I would assume that that the professional investors are absolutely on top of that and can see that. But I don't know.
Well, if you read Bloomberg, you can't. I mean,
Yeah.
Bloomberg keeps talking about high inflation rates, and I don't know why.
Yeah. I don't know. Lee, do you have a view on that? On what the print will look like?
So I don't know, but I
I'm listening.
continue to think.
Turn it down.
I continue to think that inflation is on its way down. So I don't know what the consensus is for this month's CPI number, but I'll take the under. Whatever that consensus is, I'll take the under.
Yeah.
And I don't know. Somebody tell me what the consensus is, and we'll bet $20 for the charity of your choice. I'll take the under.
Yeah. Well, I think that the housing component comes in with a lag, and I think that's been trending down, and so that's gonna that helps to keep the official number down. I think the the figure that Scott Sumner would watch is the wages or maybe the unit labor cost number, and that's staying stubbornly high. I mean, it's not in the 8 to 9% range, but it's in the 4 to 5% range, or range consistent with sort of 4 or 5% inflation. Again, if we don't assume that there's secret productivity growth. And I do think that things like trying to reduce trade and trying to shift, the government redirect the economy, building the chip factories and so on, and not, when you do that, you don't care the way the market does about cost. You just say, well, we're just going to subsidize the hell out of this and demand the heck out of that. And so I think that's, to me, so what's fundamentally inflationary to me is the attempt of the government to kind of redirect things. Plus, I don't believe that the Inflation Reduction Act is actually going to, bring down the path of government spending. So, Steve, what does the inflation nowcasting thing say? Now, of course, that's not going to tell you what the official CPI is going to say, but what is it saying is going on?
Well, that's the prediction on what the CPI will be when it gets released on Wednesday.
Okay.
That should be the second table. So 3.22% for June.
As a monthly annual rate, or as
a year-over-year percent change.
3.22.
So reflecting what Ernie was saying about losing that really bad month, we're now on the downhill trend. And so just the rollover, it's gotten to a point where we've kind of flattened out. We have to, unless it really starts accelerating. So
okay, well, so that'll put something else in the Fed's pipe to smoke over and decide what they're going to do. Okay. All right. So we haven't heard from some people who occasionally, or more than occasionally, give voices. So I'm going to put the pressure on. Elijah, do you have any comments on what you've heard so far, or questions that you'd like to throw out?
I'm not sure I have too many thoughts tonight. I guess what you were discussing about measuring productivity and the top kind of dominant tech firms being such a big piece of the stock market reminded me of Alchin and Dempset's metering problem. Basically just like even just at the micro level, looking at individual employees, it's essentially impossible for a manager to determine the marginal productivity of an employee when the output is intangible and when there's a lot of team production involved in producing that output.
And
And
when
it
there's
seems more
such
and
a,
more of the economy is becoming more and more like that, as Garrett Jones was kind of alluding to.
yeah, well, I think that's a real issue. I just, when I had my business, we were bought out, and the terms of the buyout were, on some going forward indicators. And there's this popular indicator of EBITDA, earnings before interest. I forget what the depreciation and
Amortization, taxes and amortization.
right. So, so we decided we could pretty much depreciate all of our spending if we wanted to, because there was no, everything we were doing was building a project that was going to create more revenue in the future. And if that's what everyone in the company is doing, you can't measure productivity. And that's, so that's just, it really reinforces that Alchi and Dempset's point. It's not just that you have a team of people that collectively are producing output. You have a team of people that are collectively investing in an asset that's going to produce output later. And that's just that. And again, I think that's, when we talked about the tech layoffs, I mean, maybe they're laying off DEI administrators, but they may be laying off, the people who are going to come up with alternative AI methods. And just, now they're just saying, okay, shut down all these other projects. You're all going to work on large language models now. And, that may be cutting off, future growth. Who knows? And let me put a spotlight on one other character here. John A., do you have one of your questions to throw out at us?
Well, I guess I have observations. One is economics. What's the status of economics as a science? Because I see top people in the field struggle to explain what's going on, much less predict what will happen. And so I guess it's not physics. Then my own personal experience, since anecdotes were raised before, I know of a fancy college where the tuition hike for next year is 6%. And so
and don't they all go up together?
and some of the parents are going to say, why is the tuition so damn high? And I go to the grocery store and it still bites. So those are my few observations. I'm still surprised when I go shopping, and that, then I guess I suppose energy prices are lower than people would have expected with the war with Russia.
Have we started to refill the Strategic Petroleum Reserve? Does anyone know whether we're doing that? Are we just kind of, so John, you're shaking your head. Does that mean we're not? You can unmute if you want to.
I don't know for sure, but I haven't seen a single thing that says they're starting to.
Yeah. And that would, so we managed to kind of get over that for a little while, but that means that sort of the next oil shock is going to, you're not going to be able to pull that again. I think I would rather own energy stocks than tech stocks at this point, because I can kind of suspect that I think that there's more room for an adverse energy shock than a positive one. Anyway, you know what my investment advice has been worth so far. So, I had something else, some other comment I wanted to make. What was the first point you made, John A? You have to unmute. Yeah. Oh, that
Yeah,
economists.
I'm not an economist, but,
Yeah,
and, but people I admire, and people a lot smarter
Yeah.
than I am, who are
Yeah.
well-versed in economics, struggle to explain, much less predict.
yeah. Well, I think that's been true for a while. Olivier Blanchard, who I, is somebody who I have an automatic negative reaction to. He is taking over. He is sort of the dean of macroeconomics, and so I like to always say the opposite of what he says. So, and in 2008, he wrote a paper which he said the state of macro is good, meaning that we know, macroeconomists know things. And then, of course, immediately after that, you had the financial crisis and all the, all economists had eggs on their faces. My view is that this is one of those things that's just too complex for anyone to understand, that it's not a GDP factory. We don't know what the inflation rate is. We don't know what the productivity rate is. There is no the productivity rate, the inflation rate. There are these shifting patterns of specialization and trade. I think I think in the labor market, people keep successfully discovering patterns of specialization and trade that they can sustain. Probably a lot of them are sustaining them because the government is throwing these subsidies at these manufacturing sector, and so they may not be sustainable. If you had the government back out, these companies could fall apart. But I think that it's just inherently more very complex. It's sort of like complaining about, hey, why don't neurologists understand the human brain yet? Why don't we understand why somebody is why somebody is smarter than someone else, or somebody does better on a test than someone else, and somebody has autism and somebody else doesn't, and where do emotions come from, and where does consciousness come from? It's pretty complex, and that's anyway. Elijah, you had a comment?
Yeah, this is kind of circling back to the unmeasurability of productivity and team production point, but you mentioned DEI in passing in relation to that, and it reminded me of a paper that Tyler posted a long time ago, an economics journal paper that basically found that in general, men were able to work with people that they didn't like in the workplace, like relatively well, whereas women in general kind of struggled with that. And I wonder if that kind of explains, I mean, maybe there's like kind of a good underlying economic reason why firms would be emphasizing DEI as much as they do, just because if there are like complaints or there's contention along diversity lines between men and women and between different cultural groups, then your team productivity could be taking a huge hit without you really being able to, you'd almost have to take like a vague approach to monitoring that, because you couldn't judge from the output alone whether there was a problem.
Yeah. Okay, well, that wasn't the best issue to raise at 1 minute
Yeah.
to 9 o'clock.
That's
We can maybe uh, noodle that for the next, and maybe it'd be an interesting topic to discuss of sort of, because I've written, as you know, I've written a lot on sort of organizational behavior and organizational behavior when women enter a male culture, and the challenges of that. But
Arnold, really, I know
That's-
we're at our
that's okay.
appointed hour, but related to Elijah's point, you could take up in a future discussion. What's the net effect of work from home, remote work? Because though in some, it might be improving well-being, but again, just observation, it seems to reduce productivity. This is just my casual observation of people I know, but they're happier.
Yeah.
And so what does that mean for this discussion about where the economy is going and productivity and measuring GDP and
Yeah, well, that would be consistent with the sort of doing less with more, is that you have to have more people to achieve the same goals if you can't corral them in an office. The offsetting thing is that, well, I was going to say commuting has, by reducing commuting, you may get a net gain, but maybe that's not enough. And between the people who used to commute by subway and, with modern technology could do work while they're commuting, and the people who are, listening to podcasts on the way to work and not feeling like they're losing. So maybe the loss of commuting isn't as big a gain as I would think. But yeah, that could play into the doing less with more theme that we haven't. The way I would put it is that we haven't managed to work from home as well as we might. I still think it ought to be something that we shouldn't have to corral people in offices as much as we did, but it's probably not being managed as well as it could be. It'd be interesting to see, like, even before the pandemic, I know Stripe was talking about how remote was one of their offices, and they were going to learn to manage that. And it'd be interesting to know, have they done an effect as if, if you followed what they came up with as their best practices, would you would work from home not be such a adverse productivity hit? But it's an interesting question. Okay, well, I think I will wind it up here. And thanks for the discussion, and we'll maybe at some future date try to sort out organizational culture as if that were as simple a topic as macroeconomics.
Sounds good. Good discussion.
Thank you.
Okay, bye.
Thanks, Arnold. Thanks,
Bye.
everyone.
everyone?
Bye.
Good night.